Ever wondered what an analyst really sees when they do a deep dive on an Indian auto giant like Mahindra and Mahindra? Well, today we're cracking open a detailed research note from Stressfree Investing to find out exactly that.
And we're going to start with the punchline. The analyst's main conclusion? A potential 33% upside from where the stock is trading now. Yeah, that's a pretty big number. So, the question is, how on earth did they get there?
So here's our game plan. We'll start with that final verdict, then we'll dig into the arguments for and against the stock. After that, we'll check the books, the financial health, and finally, we'll see how it all adds up to a final risk, reward, and score.
All right, first up, the verdict. We're doing this answer first style, so you get the main takeaway right at the beginning.
So, what's the bottom line? The official verdict is accumulate, and it gets a solid score of 72.1 out of 100. Based on a current market price of around 3,012 rupees, the analyst sets a base target of 4,000. And there you have it. That's the 33% potential upside we're talking about over a 3 to 5 year horizon.
Okay, so let's get into the bull case. What's driving all this optimism? Well, the analyst really centers the whole story around what they call a powerful dual-engine growth.
It really boils down to three main pillars. First, their absolute dominance in the SUV market. They are number one when it comes to revenue share. Second is that dual-engine strength we mentioned, where they're a leader in both cars and farm equipment. And third, and this is a big one, look at how much their profit margins have grown, climbing from 13% to 19% in just 5 years. That's impressive.
And this chart here, it shows you that dual-engine idea perfectly. You can see the auto segment is the biggest piece of the pie, for sure. But that farm equipment segment is also a huge part of the business. Having these two strong, separate engines is a massive strength.
But hey, it's not all sunshine and rainbows, right? No analysis is worth its salt without looking at the risks. So what could actually throw a wrench in this positive story?
The analyst flags three main things to watch out for. Number one, the valuation's kinda high. It's trading for more than it usually does. 2, M&M is a big, complex company with lots of different parts, which can make it tricky to figure out exactly what it's worth. And 3, the whole shift to electric vehicles, that's a bit of a wild card, with lots of competition and questions about profits.
Now this slide really drives home that valuation risk. This shows the price-to-earnings ratio, basically a way to see how expensive a stock is. Right now it's at about 24, which is noticeably higher than its 5 and 10-year averages. Simply put, it means the market is already expecting a lot of good news.
Okay, we've seen the good and the bad. So let's look at the foundation this whole analysis is built on. Let's do a quick financial health check on the company. And you know what? The trend here is just undeniably strong. Revenue has more than doubled since 2020. Those operating margins have expanded in a big way. And just look at the profit after tax, the actual bottom line profit. It's gone from a loss to over 16,000 crores. That is a seriously impressive turnaround. But here's a really sharp point the analyst makes. If you just look at the high-level numbers, things like debt and cash flow might look a little weak. They call this consolidated distortion. It's because the numbers include their financial services business, which, by its very nature, has a lot of debt. But if you isolate the core auto and farm business, it's actually in fantastic financial shape. All right, let's bring it all home. How does the analyst take that strong performance, weigh it against those real risks, and come up with a final score? I love this slide because it lays out the possibilities so clearly. In a bad scenario, the bear case, the stock could drop about 20%. Our base case, the one we've been talking about, is a 33% upside. And in a bull case where pretty much everything goes right, the return could be a whopping 56%.
And all of that leads to this final verdict, accumulate. The analyst sees what's called a favorable risk-reward asymmetry. What does that mean? It just means the potential gain is 1.65 times bigger than the potential loss. According to this report, the odds are tilted in your favor.
This all gets boiled down into a final score of 72.1 out of 100. That's a grade B. So what does that really mean? Well, the report sees a really great business, but the current high price tag means it's a stock to accumulate carefully or watch closely, not necessarily an all-out strong buy right this second.
Which leaves us with the big question you have to ask yourself. With that 1.65x risk-reward ratio, does the potential upside really justify the risk of buying in at this high valuation? That's really the key thing to think about here. Now, the full detailed report is attached in the description, and hey, do let me know in the comments which stock you want me to analyze next.